In this recording, we're going to look at 3 of the brief exercises and then exercise 26 as well. In brief exercise number 8, if you read through it, it is a company that assigns $1 million of their accounts receivable. And they're using it for collateral for a $75,000 note. So we can see they're borrowing $75,000, and essentially then what they're doing is just pledging their accounts receivable as collateral. So any kind of asset you have can be used as collateral, and that's what they're doing here. They're just using it as collateral. Now, in order to do that, on the day that they borrow the money, the bank is going to charge them a fee for this. And in your little brief exercise 8, it tells you that it's a 2% financing fee. Now, the interesting thing is they're only borrowing $750,000, but the fee the bank charges them is based on the collateral of the accounts receivable. So 2% of them $1 million, and that gets charged as an interest expense. So again, in this case, the assignment, they're assigning accounts receivable, means they're really just using it as collateral on debt. So you're just using it for collateral on a note payable. Okay, so terminology there. Okay, so then they're going to get the difference of $750,000. We also, if we were stopping at this point in time, we would want to disclose in the notes to the financial statements, the pledging of these assets. So in addition to making this journal entry and reporting the note payable on the balance sheet, in addition to that, we would want to report the pledging of the accounts receivable in the notes to the financial statements. Now let's switch gears. What if we were the bank? If we were the bank, then we're going to pay out the $730,000. The note's going to come in for $750,000, and we're also going to earn right away $20,000. You can see why the banks are interested in doing this. Now, this also, let's look at the next 2 months. Over the next 2 months, let's say that Chung actually collects the $1 million from the customers. Probably wouldn't collect all of it, but let's just pretend that they do. So if Chung collects the $1 million, cash will come in of $1 million. And of course, then they're going to reduce their accounts receivable. And I'm just pointing this out because, now those accounts receivable are essentially just like any other accounts receivable. So that'll happen during those 2 months. And then at the end of November, Chung will pay off the note. So recall, they've got a $750,000 note payable. So we want to reduce the liability for its amount, $750,000. There will be interest expense, so we would record interest expense. That'll be for 2 months. Let's see, 2 months of interest expense, so the principal is $750,000. The narrative tells us there's an interest rate of 9%, and 2 months out of 12 have gone by. So our interest cost is going to be $11,250. Okay, so then the total cash paid is going to be both principal and interest, $761,250. And then for the bank, instead of cash going out, that cash will come into the bank, $761,250. They will have interest revenue coming in, that $11,250. And then for them, they'll get rid of this notes receivable. No longer will they have that. I'm just going to abbreviate that, $750,000. Okay, so that's brief exercise 8. Moving on, let's look at the next, brief exercise 9. In brief exercise 9, we have a company that actually factors their accounts receivable. If you factor your accounts receivable, then essentially you are selling those. And again, the whole point of these brief exercises that I assigned is we're looking at how can a company convert their accounts receivable to cash very quickly. So one way to convert the account receivable, of course, is to just collect the cash from the customer, but that may take a few weeks. So another way is just to borrow money and use that asset as collateral. So the accounts receivable is an asset, we could use it as collateral. In brief exercise 9, what we're seeing, because it is an asset, well, it could be sold. So, there's somebody out there that's willing to buy it. So here we see in brief exercise 9 that we have a factor that's willing to buy these accounts from us. Now, it's kind of interesting. In brief exercise 9, these are sold without recourse, and that's significant. So let's talk about that a little bit, whether it's sold with recourse or without recourse. Without recourse means that the factor can't come back on us and expect to collect any unpaid due accounts. So let's look at this. Here again, we are going to be charged this 2% fee. So we're recording that as a loss in this particular case because, again, we're giving up an asset. So if you think about generally, you get rid of, if you sell an asset other than your merchandise, you give up the asset, cash comes in, right? And the difference is either a gain or a loss. So essentially that's what's going to happen here. We also have this $9,000, the 6% is just something that's going to be retained as a possible adjustment. So it's just something in the contract required to set aside 6% of the $150,000, which is $9,000. So that's just sort of being set aside for now. So again, we give up $150,000 in exchange. We're getting something like this $147,000. Doesn't quite look like a one, does it? So the difference of what we gave up and what we received is the $3,000 loss. Okay, and then just opposite, if we were the factor, we're going to have an accounts receivable coming in. We're going to have this due to, so some sort of possible liability account here. If we need possible adjustments, that loss becomes a revenue for us because this is our main, probably our main type of business, and then we're going to give up cash. Okay, so there's brief exercise 9. We're actually factoring or an outright sale of our accounts receivable. We're giving them up. Now let's contrast this factoring in brief exercise 9 with that in brief exercise 10. The only difference in these two assignments is that in 10, the accounts receivable are sold with recourse. If they're sold with recourse, that means the factor can come back and expect us to pay if our customers don't. Because of that, then, we need to build in some sort of liability account for ourselves, right? Because it's possible we won't be able to pay, or in this case, will not be able to pay. That the customers won't pay their accounts, accounts, and so Wood will have to come up with that money for the factor. So there is an estimated $7,500. That's usually more complicated to calculate, but your book is just giving you again, it's going to be an estimated amount that Wood is estimating that it's likely that $7,500 of these $150,000 accounts won't pay. And so the rest of it's just the same. Anticipating, the $9,000 due from the factor. So again, the loss is going to be a little bit different though, because if you think about it, here we've got accounts receivable is what we're giving up. That's $150,000. The net proceeds of what we're actually getting in return would be this, $148,000. But then we need to also factor in, we may have a liability of that of $7,500, and so that net difference is this $139,500. So again, we're giving up accounts receivable, We're bringing in net the 138 and the 9 less the 7,500. So this time we have a bigger loss, 10,500. Okay, so that gives you an idea then, how are we going to account for it with recourse? The main thing is setting up this liability account. Okay, then our final exercise that we want to go over is exercise 26. This actually is in one of the in an appendix to chapter 7, but it's kind of an important problem a little bit, because we're going to look at impaired assets, down the road as well. Not just accounts receivable, inventory can become impaired, property, plant, and equipment can become impaired. And so we want to look at, what are we going to do if our assets lose value? What do we need to do? Well, the reality is this is a loss contingency. There's always a contingency that our assets will lose value. The question is, when do we actually record it as a loss contingency? Well, we record it if it's probable that we're going to incur a loss. Is the value of the asset going to stay down? Is it going to go down in market value, for quite some time, permanently? Is it actually going to probably be permanently impaired? And secondly, so if it's probable that we're going to experience a loss on this asset, and we have to be able to reasonably estimate the dollar amount. So we have to be able to come up with an estimate of the loss. Bad debt expense is a really good example of a loss contingency. Bad debt expense are when our accounts receivable, when it's probable we won't collect those accounts, and we can reasonably estimate a bad debt expense. So bad debt expense is a good example of a loss contingency. Well, we're going to look at this in terms of notes receivable. In this exercise, the company actually issues cash, issues up cash for a note receivable. And the note supposedly is a non-interest bearing note, and by now we know there's no such thing in substance, in economic substance, there is no such thing as a non-interest bearing note. So here's what the cash flows look like. There will be $100,000 paid in 5 years. The interest rate is 10%. I'm going to go ahead and maybe plug that in. So we know N is 5. The interest rate is 10%. There are no payments, and we know the future value is $100,000. So the question then, is what's the present value? So if you key all of this into your calculator, we want to know how much is it worth today. We'll get the $62,092. So the present value is $62,092, and we would make this journal entry where we put cash will be given up for that amount, and then we're going to break out that $62,092 between these two accounts, notes receivable and the discount. And when we net those, we'll get this carrying value of $62,092. The solutions on this just shortcutted. We're not really going to see the notes receivable and discount throughout the rest of the problem. Okay, so that's part A. Then 2 years go by. So this is the first year. We made our journal entry for the first year. Then 2 years go by, and we're going to jump in. Here it is at the end of year 2, beginning of year 3. And now they very much have an understanding with this customer. The customer's having financial problems. They only expect to collect $75,000 instead of the $100,000. So that's an impaired asset. We know we're not going to get our full $100,000. It's both probable and we can reasonably estimate it. So what we're going to do then is we're going to figure out now at this point in time what's the present value. So we are going to go in, and enter in all the variables that we know. Now there's only 1, 2, 3 periods left. Assuming the same interest rate on the of 10%, because that's what we locked into earlier. We want to solve for present value. There aren't any payments. We know the future value this time is $75,000. And so what's going to be our present value, and if you key all that in, you're going to get this $56,349. Okay, Well, here's what we have in the accounting system right now. We have a net value of $75,131. Now we want to reduce that down to the $56,349. And that's going to be, if you take the difference in those two numbers, that's going to be our loss due to impairment of this $18,742. And given that it's dealing with some sort of receivable, we'll just make the same sort of entry, bad debt expense and allowance for doubtful accounts, but now this is going to apply to notes receivable, not our account receivable. Right? So that's impaired assets. For receivable, we're very much, in essence, seeing that with accounts receivable. Here's another example of it with the notes receivable.